Hi, I'm Alan Moore, Certified Financial Planner and founder of Serenity Financial Consulting. Thanks for joining me. It seems like every week the SEC is shutting down another Ponzi scheme. Just last week, they shut down a Ponzi scheme that involved over 1 million investors worldwide. These schemes have been around since the 1920s and are basically fraudulent investments that instead of paying investors money based on earnings or company profits, they give older investments the money that newer investments put into the scheme. It basically can continue until there's no more new investors coming along. There are 4 easy ways to avoid investing in a Ponzi scheme that are pretty important. The first one is ensure your money is held at a third-party custodian. So one way that Ponzi promoters will get away with their scheme is that they will give investors fake or doctored investment statements. This works as long as you're not getting statements from somewhere else and you have nothing to compare it to. So when you have your money at a third-party custodian, the custodian is going to send you regular statements, and you can compare these statements to what your investment advisor sends you. If there are any discrepancies, you need to look into it immediately. Third-party custodians are companies such as Schwab, TD Ameritrade, Fidelity, Trust Company of America, Scottrade, these types of companies. The second way to avoid a Ponzi scheme is to ask for the prospectus. Okay, every investment filed in the U.S. With the Securities and Exchange Commission are filed with a prospectus, which is basically just a legal document explaining the investment. If you request the prospectus, you will more than likely catch most Ponzi schemes because most Ponzi schemes are not filing with the SEC. The third way is be wary of consistent or higher than normal returns. If you have an investor or investment manager, an investment that is returning higher than market returns on a consistent basis, you need to be very cautious. Research has shown time and time again that investment managers cannot consistently beat the market. Beating the market one year is a fluke. Beating it over and over should cause a red flag. Another thing to note is whenever an investment is returning consistent returns, such as 10% a year for the last 5 years. Investments rarely return consistently like that, and it's something you should raise a red flag for you. The last way to avoid a Ponzi scheme is to trust your gut. Too good to be true is just that. It's too good to be true. If you are seeing something that just doesn't quite feel right, back away. If you're not sure, you're kind of on the fence, maybe it's a good idea, maybe it's not, consult a fiduciary investment advisor that is not related to the scheme at all that can help you evaluate the investment. Trust your gut, trust your instincts. The only guarantee that a Ponzi scheme has is that it will take all of your money. So you need to be very cautious. Very smart people have lost life savings by using Ponzi schemes, and too often they come back and say, well, if only I had known. Okay, you want to be very cautious. Trust your instincts. So what do you think? Have you or anyone that you know of ever gotten duped into a Ponzi scheme? Have you ever been offered to invest in a Ponzi scheme? Why did you invest in one, or how did you know not to? Feel free to comment below. Thanks for joining me.